Good afternoon and welcome back to the Camarda Wealth Channel. I am your host, Troy Lerche, bringing you the Week in Wealth. As you can see from the background of the Jacksonville Naval Air Station that I've added, I wanted to take a quick minute and thank all of the brave men and women of our armed services for everything they do to keep us safe, here and abroad. We appreciate their sacrifices and their families' sacrifices as well, and we couldn't live in the greatest nation on earth without them. So thank you very much. Without further ado, we'll jump right into the CAPE indicator. The CAPE indicator actually went down a little bit. It's at 38.58, which was down from 38.81 last week. We still remain in cyclical bull territory. And last week, though, with the volatility, we did have one of our indicators change. So we have 3 of the 4 of our indicators are green. The one that changes quite often, and we don't. It's just kind of a leading indicator that we monitor very closely, but it does not signal or trigger any trades on the investment front. And with that, I'll lead right into the U.S. markets. The U.S. markets last week pulled back for the week, but not before the S&P 500 reached a new record high on Monday afternoon, and then the rest of the week pretty much pulled back. The Dow Jones pulled back 395 points, which was a decline of 1.1%. The NASDAQ retreated for the second straight week, giving up 0.7%. We had by market cap, large caps declined 0.6%, mid caps 2%, and the Russell 2000 small caps 2.5% down last week. In international markets, major international markets finished the week in the red as well. We had Canada's TSX declined just under 1%. The United Kingdom's FTSE 100 retreated 1.8%. On Europe's mainland, France's CAC 40 and Germany's DAX pulled back 3.9% and 1.1% respectively. And Asia's China Shanghai Composite gave up 2.5%, while Japan's Nikkei ended the week down 3.4%. So overall in the international markets, we had developed international markets retreated 2.4%, and emerging markets fell a much steeper 4.3%. So, and they actually had the previous week were up a little bit. So, it's showing some volatility out there in the markets. With commodities, like equities, commodities finished the week predominantly down. West Texas Intermediate crude plunged 9.2%, which we saw in the energy sector. It was hit pretty hard last week. Silver declined 2.8%. Gold actually managed to have a slight increase of 0.3%. And copper, one of the big industrial metals, sold off 5.8%. In U.S. economic news, we had the number of Americans filing for first-time unemployment benefits to a new pandemic low as companies continue to hire almost anyone willing to work. Analysts note the big question is whether more people return to the labor force in the fall as expected when schools reopen and the extra federal unemployment benefits run out. Federal Reserve officials, for instance, worried Delta could delay their return to work and prolong the labor shortage for at least till the end of the year. We've seen some drops in home builders. So confidence amongst the nation home builders fell to the lowest level in a year as home prices continue to soar. Concurrent with the NAHB report, the Census Bureau reporting building activities for new homes slumped in July, reflecting the continued supply constraints facing construction firms nationwide. On the other hand, permits for new homes, which give analysts a gauge for future building activity, rose 2.6% in July and 6% from a year ago. So analysts note that the pickup in permitting is a positive sign that the housing market's still on relatively solid ground. And then consumer sentiment unexpectedly plunges in August. Data suggests that consumer optimism may be waning. The sentiment decline is evident across income, age, and education brackets and seen in all regions. It also covered all aspects of the economy, including personal finances and economic prospects. We attribute a majority of the decline to the ongoing Delta variant surge, which has led to the rising COVID case counts and hospitalizations. Consumers are understandably concerned about restrictions being reimposed and the economic recovery slowing near term. Beyond the Delta variant, persistent inflation pressures and rising prices across everyone's goods are also weakening consumer sentiment. The sudden consumer sentiment decline will play a role in the Fed's upcoming policy actions. Consumer spending accounts for nearly 70% of the US economy. The new data could push back the Fed's expected interest rate hikes timeline and give dovish members a justification to hold back on tapering. The question is whether August week sentiment is an emotional response from consumers hoping the pandemic would end soon or an indication of deep-seated issues. Either way, the Fed's Jackson Hole meeting next week just got a lot more interesting. On that note, we hope everybody had a great weekend. Stay safe out there, have a good week, and we'll talk to you soon. Bye.